Okay, let's unpack this. We are looking at something absolutely fundamental today. Household consumption and spending. I mean, it's basically the engine of the economy, right? In most developed places, consumer spending, well, it's easily over half of GDP. So when consumers change how they spend or what they spend on, the whole financial services sector, it has to react fast.
It really is a fascinating shift, almost seismic. We've seen multiple global events, haven't we? The 2008 crisis, then the pandemic, now this period of high inflation. All of these have structurally reshaped how people behave financially. The consumer we're looking at now is, well, much more conscious about value, expects everything digitally, and is, frankly, more socially aware than ever.
Right. And this analysis, it's really your shortcut to understanding that pivot. We're going to explore the key changes in behavior, the tech that's driving it all, and importantly, how financial services providers are scrambling to adapt their lending, their products, even their compliance, just to stay relevant. Oh, and just before we dive in, for those of you who need it, remember that completing the Schultz quiz after this segment earns your CPD certificate. First, let's set the scene. How did we actually get to this point?
Okay, so if we rewind, say, before the year 2000, we were in an era you could probably call stability and predictability. Looking back at the data, spending was pretty closely tied to income. Most shopping happened in person, and trust in the big traditional banks is solid.
Yeah, really solid. People often banked where the parents did. Loyalty was strong, built on those branch relationships. But things started to get shady between 2000 2008. That was the rise of credit era. You had deregulation, low interest rates. It encouraged massive borrowing, mortgages, yes, but also lots of consumer credit. People started spending a lot more, especially on non-essentials. And that reliance on easy credit, well, it built up a huge vulnerability, didn't it? Which brings us to the really critical moment, the global financial crisis, say 2008 to around 2013. That was just a watershed.
Absolutely, a complete watershed moment. It wasn't just about losing money. People lost faith.
Exactly. That loss of faith feels like the key.
It was. It triggered this really deep uh, cultural shift toward being more careful. Prudence, basically.
Yeah.
Suddenly, paying down debt was the priority. And there was this huge skepticism about the traditional banks, the ones seen as causing the whole mess. That erosion of trust, it really paved the way for new digital players. If you didn't trust the teller anymore, maybe you'd trust an app, an algorithm.
Which leads us neatly into about 2013 to 2019, what we're calling the digital experience economy. The focus shifted, didn't it? Less about buying stuff, more about buying experiences. Travel, streaming, wellness.
Yes. Driven a lot by millennials and Gen Z. This idea of access over ownership really took hold. Think about it. Why buy CDs or DVDs when you can stream everything on Netflix or Spotify? Why own a car that just sits there when you can grab an Uber? And financial services, they had to scramble, invest huge amounts in mobile apps, user-friendly platforms, trying to match that seamless tech experience people were getting elsewhere.
Then, bam, COVID-19, the ultimate accelerator. It didn't start the digital shift, but wow, did it speed it up? Like 5 years in one, e-commerce, contactless payments, remote, everything suddenly became essential.
And crucially, the data from that time shows it really exposed these widening financial gaps. You had higher income households actually saving more they couldn't spend on travel or eating out. But lower income groups, they often face job losses, mounting debt, real financial hardship. That split, that dual reality, is fundamental to understanding the consumer today in the 2020s.
Okay, so that brings us right up to now. And there are some really powerful trends shaping things. First up, trend A, digital first consumption is just dominant. The digital economy basically is the economy now. The figures suggest global e-commerce sales heading towards, what, over $7 trillion by 2025? That's huge.
But how is finance itself woven into that massive online marketplace?
Well, the prime example has got to be buy now, pay later, BNPL. It just exploded, didn't it? A major alternative to credit cards, offering those short-term, often interest-free installments right there at the online checkout. Hugely popular with younger consumers, especially those wary of traditional credit card debt.
But hang on a second. Is BNPL just, old wine and new bottles? Isn't it just easy credit again, like before 2008? How is it really different? That's the million-dollar question, really.
Right.
It offers flexibility, sure. The structural difference, proponents would say, is the transparency and the transaction-specific nature. It's a microloan for that purchase, not an open credit line. But, and this is the big but, it puts enormous pressure on providers. They have to balance these fast new lending models with being responsible, being transparent, because the concerns about people racking up debt across multiple BNPL services, those are very real.
Right. Convenience versus consequence. It's a constant tension. And that convenience sometimes clashes with the next big trend, Trend B conscious consumerism. People are increasingly spending, based on their values, ethical, social, environmental things, ESG values. It's not just about the price anymore.
Absolutely. And that's forcing banks and financial firms to adapt, not just talk the talk, but change products.
Hmm.
We're seeing more green banking options, ethical investment funds, even tools like carbon footprint trackers built into spending apps. Firms that ignore this, especially with millennials and Gen Z driving so much consumption, they risk becoming irrelevant quickly.
Speaking of price tags, Trend C is hitting almost everyone, everywhere. Inflation and price sensitivity, global inflation, rising interest rates, it's just squeezed disposable income like crazy.
And you see the behavioral change starkly in the data.
Hmm.
People are cutting back hard on discretionary spending, focusing on essentials. This shift means financial institutions are seeing huge demand for things like flexible budgeting tools, help with debt consolidation, personalized advice, often delivered instantly by AI, just to help people manage budgets under pressure.
Which links perfectly to Trend D, the big demographic shifts. Millennials and Gen Z are the dominant groups now. They don't just prefer digital, they expect it. They value experiences, transparency is key, and they use digital tools for pretty much everything finance related, very different from older generations.
And that reliance on digital naturally brings us to the engine behind it all. Technology and data. It's changing everything.
Right. Financial institutions are now using absolutely vast amounts of data. Transaction history, sure, but also how you use their app, maybe even location data, building these incredibly detailed pictures, big data, driving hyper-personalization.
And the upside, when it's done right, can be genuinely helpful. AI models can sort of anticipate what you might need, like the system might notice you regularly have a bit left over each month and proactively suggest a savings plan tailored to exactly that amount. Takes the effort out for you.
That's the dream, isn't it? Proactive support, not just reactive service. But it hinges on using that data ethically. There's a fine line between anticipating needs and, well, manipulation. Or worse, excluding people based on biased algorithms.
Exactly. And that drive for convenience also powers financial automation and embedded finance, the whole set and forget idea. Automation examples are everywhere now. Those automatic roundups, sending spare change to savings, maybe automatically splitting your salary into different pots when it lands, real-time alerts if you're about to go over budget.
And embedded finance, that's where it gets almost invisible, right? Finance just becomes part of something else you're doing. Can you give a clear example?
Yeah, it's about making the financial part so smooth you barely notice it. Think about booking a flight online. You click book, and maybe an option pops up to add travel insurance with one more click. That's embedded insurance. Or using a BNPL option right there on the retailer's checkout page without ever having to go to a separate bank site. The finance is just part of the shopping.
And all this data, this non-traditional data, it's also changing how creditworthiness is assessed. AI in credit assessment is shaking things up. Traditional credit scores are being supplemented, sometimes even replaced.
What's really interesting is the kind of alternative data being used now. Thanks to things like open banking, firms can look at your real-time income and spending, your rent payment history, even utility bills. This can potentially open up credit for people who were previously excluded. Gig workers, people with thin credit files.
Which sounds great for financial inclusion, reaching underserved groups. But the flip side is the risk of algorithmic bias, isn't it? If the AI is trained on data that reflects historical biases, it could actually make inequalities worse, just hidden behind a veneer of tech. Fairness is a huge concern.
Well, the industry reaction has basically been forced innovation. The old one-size-fits-all product, it's dead. Consumers demand flexibility, personalization. That's why you see things like usage-based insurance, your premium changes based on how you drive, for instance, or instant salary advances linked to what you already earn.
And the pressure from neobanks and fintechs is intense. Those nimble startups are forcing the big established banks to either innovate like crazy or partner up to get the tech and speed they need.
We're also seeing big shifts in savings and investment behavior. Again, driven by younger people, they seem less intimidated by investing maybe, so you see this boom in micro-investing apps. And robo-advisors offering low-cost automated portfolio management are really taking off. The lines are blurring completely between banking, saving, investing, often all happening in one super app.
With all this rapid change, regulation has to keep pace, which is tough, especially around things like BNPL transparency and making sure those AI credit models are fair.
If we look specifically at the South African context, it's actually a really interesting case study. You've got this balancing act between embracing tech change and tackling really high levels of financial exclusion.
So what stands out there? It seems like a dual focus. protecting consumers and actively trying to include more people financially? Who are the key
Well,
players?
you've got the National Credit Regulator, the NCR. Their role in preventing reckless lending is absolutely critical given the levels of consumer debt.
Yeah.
Then there's POPIA, the Protection of Personal Information Act. That's South Africa's equivalent to GDPR in Europe, setting strict rules for data protection, which is vital as personalization increases.
And it sounds like they're not just reacting, but trying to guide innovation, too, through something like a regulatory sandbox.
Exactly. The Intergovernmental FinTech Working Group, or IFWG, runs this regulatory sandbox. It's clever. It lets fintech companies test out new ideas like a new AI credit model in a controlled environment with regulatory oversight from the start.
So it encourages innovation, but with guardrails.
Precisely. It helps ensure that new tech aimed at serving the often large underserved market is designed with ethical data use and consumer protection baked in right from the beginning. It's about responsible innovation. Hashtag tag tag outro fan.
So wrapping this all up, what does it mean for you, the consumer? Well, the future of finance seems to be about deep personalization, making it seamless, almost invisible in your daily life. Institutions, the banks, and others, they need to shift their mindset, move beyond just selling products like loans or accounts, and become more like service providers focused on your overall financial wellness.
Yeah, and if we just take a step back and look at the bigger picture, all this tech offers amazing convenience, doesn't it? Embedded finance, automated tools. But as we increasingly rely on this set and forget finance, on predictive AI, managing our money, our savings, our debt for us, it does raise a pretty fundamental question. In this pursuit of ultimate simplicity and automation, are we potentially sacrificing the critical thinking and the active engagement that's really needed for genuine long-term financial resilience? That's maybe something worth thinking about as you navigate this new financial world.